Hi guys, good evening. I'm just going to give the other attendees some time to make their way into the room. We've opened it a little bit early this time, so just bear with me while we wait for the other attendees to join. Guys, while we're waiting for the other attendees, can I just check that, just bear with me. Can I just check, can you just let me know if the screen is, the welcome slide is visible and you can hear me loud and clear? Just type Y or N in the chat box. That would help me out a lot. So we know the, thanks, Adam. Cheers. Hi, David. Hi, Mustafa. Good to see you. Right, let's kick this off. So look, a warm welcome to this evening's presentation on, as you can see on the slide, on technical indicators, where we'll unwrap the world of indicators and look at their basic mechanics. By the end of this presentation, you will have an understanding of two of the most popular indicators, moving averages and the RSI, or the Relative Strength Index. Now, first of all, I wish to thank each and every one of you for trusting me with your time. And I sincerely hope we're all able to walk away from here more knowledgeable and informed traders. However, it is important to note that this is a beginner's webinar, hence the introduction, and this may be somewhat simplistic for, shall we say, more experienced hands. Now, so look, I assume as we've already tested, I assume the audio and visuals are working well. So look, any problems, do let me know in the chat box, and we'll try and get things sorted for you. So look, I assume in each and every webinar, I do say this: if I miss any questions, please feel free to, or you need further clarification on anything I've mentioned, please feel free to fire over any questions to the research team at either support@fpmarkets.com, or alternatively directly to the research team at support@fpmarkets.com, and we'll reply as soon as we possibly can. Okay, so look, this is the disclaimer. It basically says anything I say here should be taken as educational purposes only. This is an educational webinar, and it's not direct investment advice. Just a little bit about me for anyone that's unaware. Let me just see. Okay. For anyone that's unaware of who I am, so my name's Aaron Hill, and I'm the technical analyst for FP Markets. I have more than 12 years trading experience in the financial markets. I'm also a CMT, and on the back of completing CMT level 2, I received the CFTe qualification in 2020. Now, for me personally, I am primarily a technician, so my main focus is price action, Fibonacci. I really like the relative strength index, and I also look at what I like to term as chart psychology, but many other traders will look at this as order flow. So I like to try and assess where the stop losses are, where the weakness is, where the strength is, and I try to trade based off of that. So what are technical indicators, and do we really need them to make informed trading decisions? And that's a question new traders often ask. Hopefully by the end of this presentation, you will be able to answer this yourself. I personally have found some indicators useful. Obviously, it'd be almost impossible to cover each and every indicator in. So I will look at the most popular and those I've actually found use in. So it may or may not surprise you that there are in fact hundreds, you could even say thousands of technical indicators available for us traders to navigate the markets with. Just check out TradingView's, TradingView's indicator library to see how many there are available. You can also check out MQL4 and MQL5, of course, for MT4 and MT5 for their respective custom-built indicators. This is where it goes into thousands of different indicators available. Talk about analysis paralysis, I guess you could say there. Let me just see, we have a question. Will you please record the session for me? I believe the sessions are recorded. Sia, I'm sorry if I pronounced your name wrong, but I do believe the sessions are recorded. So look, at its core, technical indicators are mathematical calculations derived from price data, volume data, and also open interest data. So we can effectively say an indicator is a derivative of price and volume, right? Much like a stock CFD is a derivative of its underlying asset, underlying stock. Yes. Bear with me. Okay, so look, extending this principle, technical indicators can be broken down into a handful of baskets or categories. First up, we have trend following. Look, I'm sure we're all pretty familiar with trend following systems. Think of moving averages. And then we have oscillators, momentum indicators. So trend following indicators, you have the ADX, you have the moving averages, as I just said. We also have oscillators and momentum oscillators. Think of the RSI, as you can see here, the MACD. Volatility, think of Bollinger Band. So volatility is a way to gauge the volatility of the market. So we also have the ATR, right? I will touch on that very shortly, only briefly though. We also have support and resistance indicators. So in addition to us actually going to the charts and applying our support and resistances to the charts manually, we also have, you can look at round numbers, psychological figures. You can also look at pivot points and things like that. Sentiment. So look, for sentiment indicators, I'm really referring to things like the SIBO Volatility Index, or VIX, futures open interest, if you look at that, the COT report, commitment of traders report, and also position summaries from the individual brokers will provide you sentiment. So look, and then finally we have, as you can see there, volume. Volume, so we have indicators based on the back of volume. So we have on balance volume. This is a common one we see. I see traders take advantage of, or volume related oscillators like the volume oscillator. That's another popular one. Bear with me a minute. I'm just checking the questions. SMA is an indicator. So look, Mustafa, I'm not sure if that's a question or you're telling me the SMA is an indicator. So is it a question, or please let me know what you're referring to there. Okay, so let's move on. So look, another key consideration, of course, is it's a question. Okay, the SMA. I guess you could say, yeah, the SMA is an indicator. It's primarily found in trend following systems, and it's also a lagging indicator, which we'll get to now. So yeah, I do believe it's an indicator. Look, all the SMA is a simple moving average. It's an average of price. It's not the holy grail, guys. If you're thinking about applying this to the chart and making your millions, I would seriously consider your position in trading. So yes, I would never base my trading decision on just the SMA position. So look, as I said, we have another key consideration, of course, is the leading and we have leading and lagging indicators, much like we get the leading and lagging economic indexes that we get from the conference board, right? And it's important that we understand the difference between a leading indicator and a lagging indicator when we're making trading decisions. So on the screen, we have a leading indicator, which is a signal that forecasts price movement prior to a price move forming. I hope that makes sense. It essentially leads price, so it forms prior to a movement in price being seen. So lagging indicators, as the name implies, lags market action. So lagging indicators, it's not on the screen, guys. We haven't got a slide for that. It's just I'm going to briefly explain it. So a lagging indicator is there to confirm a market's move. It's effectively providing a delayed feedback, right? So think of this as an indicator that actually follows price. So once price has turned lower, what you'll normally see is the SMA. If you want to look at the SMA, that will also turn lower, you know, depending on the sensitivity of the SMA. So if you're looking at a 10-day SMA, that will turn pretty much following a price turn. But if you're looking at the 200-day SMA, that will take a lot longer to actually fold over after price has turned to the downside. So look, it's important to realize that technical indicators, I really want this to get this across before you start flooding your charts with technical indicators. It's very important that technical indicators are not designed to give you 100% accuracy. They're designed to help put the odds. This is very important, to put the odds of in your favor. I hope that's clear, guys. So I don't want to see a truckload of charts with 10 indicators attached to the bottom of your price chart. So look, what you can see here is an image of price data and volume data. So price data, I hope it's pretty much self-explanatory. What it is the open, high, low, and close points of each candle or bar, depending on what time frame you use. So it's over a specified setting. So this could be the 1 minute time frame. This could also be the monthly time frame. So these could be monthly candles. Okay, so now look, we won't be getting into volume or open interest today, really, but suffice to say that that the volume represents the total quantity or shares or contracts for derivatives that have been traded. Now, do be aware that that in the retail FX market, most brokers display they actually display tick volume, which measures the number of times price moved. So a number of times the offer was taken, number of times the bid was taken. So price actually has to move, or shall we say, ticked higher or lower. Open interest is commonly associated with the futures markets. And what this is the total number of outstanding futures contracts held at the end of the trading day. So it's current active futures contracts. So a technical indicator, this is how you'll see technical indicators shown on your chart here. So it's generally shown at either the bottom of the chart or at the top of the chart. That's generally where, or it can be an overlay, right? So as you can see here, we have the Bollinger Bands overlaid on the price, itself. Some indicators do actually give clear buy and sell signals. Others certainly need to be interpreted based on a specific strategy. Ultimately, though, what we they are there to identify or forecast potential trends, right? And or overbought and oversold conditions, as you will see very shortly. So look, let me just see. We have some questions. Okay, where can we get the volume? Now, the volume is, if you're trading retail FX, if you're trading with FP markets, the volume you will receive is tick volume. So you can get the volume, you can get the tick volume from the chart by simply going to MT4, your MT4 platform, and selecting volume, and it will come up similar to what we just saw on the slide there, and that's for Mustafa. Okay, so I hope that answers your question. Okay, so look, indicators can reveal a number of things, right? So what it can do, it can reveal the average price of a security. Think of the moving averages. It can also provide a clearer picture of support and resistance. So for many newer traders, support and resistance can be very difficult to plot manually, right? So we can use things like the pivot points. So look, the pivot points is basically an extended range using the previous price data. So if we want to extend a range into tomorrow, we would have to wait until, if we're using daily prices, by the way, we would have to wait until 5 p.m. Eastern Standard Time this evening, and then we would calculate our pivot points for the next trading sessions. And look, that a pivot point is formed of the pivot point, R1, S1, and all the pivot point really is the average of the high and low and close price divided by 3, right? And if you want to calculate the R1, if my memory serves me correct, that's 2 multiplied by P R1 minus the low for the previous day, and for the S1, it's 2 multiplied by P minus the high for the previous day, and that will extend into the range. Of course, you do have R2 and S2 as well. For the life of me, I cannot remember how to manually calculate those, but it's a relatively simple calculation. So we have a question here from Adam. What does a gap indicate? Now, a gap indicates that there was a very liquid part of the trading session. So you rarely see them in the FX market. So price actually, so there was a lack of willing buyers and willing sellers during that time. So price will jump to the next area of offers or bids. You normally see these on the weekend when something's happened over the weekend. And yeah, so a question from David. What's the indicator that's at the bottom? That's the RSI. That's the RSI. We'll be going over that very, very shortly. Other ways, other things indicators can reveal, of course, is trending markets. Again, think of the SMA or the EMA. It can also measure the strength of a security's momentum, right? The RSI, based on the chart, as you can see, here's a clear example of this. Also volatility, right? So we can gauge how volatile a market is. We have the Bollinger Bands plotted on the chart here, and that gauges the volatility. So as you can see here, we have 3 bands. Within this, the default is the 20 SMA, the 20 simple moving average, 20 period simple moving average, excuse me. And the upper and lower bands are generally set to standard deviations. So what you'll generally see is when price reaches the extremes, you might see a pullback. So it's and a reversion to the mean, which the mean, of course, is the SMA. But look, when you see price, when you see the, I'm trying to find an example here on the chart, but when you see the indicator, so look for here, when you see the Bollinger Bands actually contract, as you can see here, what that's telling you is volatility has contracted according to the previous 20 periods. Okay, and then when you see the Bollinger Bands expand, you'll see volatility. It's basically telling you that volatility has expanded. You can find, Bollinger Squeeze, Bollinger. Oh, I forgot the other one. There was another method that you can use with the Bollinger Bands. I don't personally use the Bollinger Bands unless I'm using it on the VIX to get my standard deviations for the VIX. But other than that, I do not use the VIX. We can also use the average true range to gauge volatility. Of course, the calculation for that is the current ATR equals the prior ATR multiplied by 13 plus the current true range, and then divide that by 14. So the current true range is all the current true range is the greater of high minus low, today's high minus today's low, today's high minus yesterday's close, and today's low minus yesterday's close. So it's the greater of those two. And what that does is that incorporates any gaps that have occurred. Right. Okay, two indicators newer traders often begin with are moving averages and the relative strength index, as I've already said. Trend following indicators, for example, are often lagging. A classic trend following method is where you have two moving averages. You look for the crossovers within the from the moving averages, right? So you look for a crossover there, crossover to the upside, crossover to the downside. Look, I hope those questions I answered fully. Adam, are you Adam Hansey? I'm sorry if I pronounced your surname wrong, but are you clear with what a gap is now? Look, just if not, please just Google this. There's so much information about gaps and things. And just say what is a gap, and it will tell you. It will probably give you a better explanation than I can live, if that makes sense. Okay. Oh, thank you, Adam. Excellent. Right. So, right. Yes. So two of the most popular are moving averages and relative strength index. Right. Okay. Let's move on, guys. Right. What are moving averages? So look, moving averages are one of the oldest tools. They're one of the oldest tools used in technical analysis, and they represent essential. They're essential elements for many of the indicators that are used today, such as we just saw, the Bollinger Band, right? So the Bollinger Band that has the 20 periods simple moving average, and we also have the MACD, right? The moving average convergence divergence, which is a bit of a mouthful, but the moving average convergence divergence, or the MACD, actually works with a 12-day EMA, an exponential moving average, and a 26-day exponential moving average, as well as a 9-day EMA of the signal line, which is made up of the 12-day and the 20. The difference between the 12-day and the 26-day EMA, if I'm not mistaken, it's a long time since I've actually had to calculate the MACD. Right, so a moving average is formed in the shape, as you can see on the chart, a moving average is formed in the shape of a constant period average, usually, now I'll say usually, fashioned by closing prices. So what it does is an average of, so if we've got the 200 period moving average on the chart, that's an average. That's just an average of the prior 200 closing prices. That's all it is. Nothing special really here. But though the calculation can be, it can be based off of highs and lows. You can form a moving average from that. As long as the data points are consistent, right? So we have closing price, a number of closing prices, consistent. That's what I'm looking for. Consistent data. You can form a moving average. So look, moving averages, as you can see from the slide, they do a superb job in toning down price fluctuations. Now, look how volatile some of the price movement here is, and look what the moving average does. It actually tones down. It actually, it takes away the minor fluctuations, right? And it gives you an almost clearer picture, especially for newer traders. This is ideal for identifying trend, right? And things like that. As I said, you will find many trend-following methodologies adopt moving averages. The most common moving average is, as I've explained, the simple moving average, or SMA. And this is a calculation that provides equal weight to the each data point. So there's no weight on the recent prices or anything like that. On the slide, this is a representation of the 200-day simple moving average. Now, the SMA, quite simply, is calculated by dividing the sum of a set of prices by the total number of price points found in the series. Very simple calculation, guys. So really, a moving average is just one value. It's just one value. It's just one value representing an average of previous data points. For example, a 10-day SMA is one number highlighting the previous price points for the past 10 days. Or in this case, on the slide, a 200-day SMA is one number that describes the average price over the last 200 days. Okay, or periods if you use a different time frame, of course. Now I have changed slides there. You can see there's a different color moving average on the chart. So in some circumstances, recent price data may command more attention than previous price values. So fortunately, we have the option. So what I mean by that, may command more attention. So if price has been ranging for the past 10 days or 5 days, but the subsequent 5 days were quite volatile, you might want to add more weight to the more recent price data. Now, fortunately, as I said, we have the option of applying more weight in favor of recent observations. Consequently, and what this does, as you can probably see, look, if we can compare this chart to the previous chart, look at that, the difference, right? This is an EMA, the blue is the EMA, this is an SMA. The lag is less of a lag, and as you can see, it actually tracks price a lot closer, in my opinion. So a weighted moving average, like the exponential moving average, or EMA, which is shown on the slide, does not calculate with equal periods, right? Whereas an SMA actually is an average of. So Adam, I see your question. EMA and SMA definition. So an EMA, an exponential. I'm going to explain them. I've already explained the SMA. So the SMA, the simple moving average, is literally an average of previous price points. That is all it is, and it's all it is the sum of a number of periods a number of periods summed together divided by the number of periods in your calculation. That is all it is. Okay, you will see the EMA, the exponential moving average. All this does is simply applies more weight to the more recent observations. Hopefully, by the end of this calculation, it might make more sense. So the SMA, equal price points. Okay, there's no weight. Is it all equal? All the observations are equally weighted with the SMA, but the EMA, by applying more weight to the current data, will follow prices more closely, as you can see on the slide. So another important point to bear in mind is the SMA actually drops older data points. So if we're using just, say, a 10-day SMA, once day 11 comes around, we drop day 1, okay? And day 11 becomes day 10, and so forth and so on. Which can be, obviously, which can be very problematic if earlier data displays considerable change. The EMA actually maintains the older information. Now, so this is the calculation for the EMA. Now, look, guys, you don't have to remember this. You don't have to remember this at all. It is calculated by your broker on the broker's platform. But look, I will go over it just briefly. Right, so as for the EMA calculation, we must remember we want more weight on recent data. So look, as you can see here, EMA day I, EMA today equals weight current. So to find the weight current, all we do is bear with me. To find the weight current is 2 divided by 11. That's if we're focusing on a 10-day EMA. EMA. Excuse me, guys. EMA. Okay, EMA. So if we're focusing on a 10-day EMA, to find the weight, the current weight is 2 divided by 11. Now do that on your calculators. That should come to 0.1818. So that is your current weight. Now multiply this. So this is one function here. Multiply this by the data for the closing price. Let's put CP here. The closing price of the current day. Okay, so we multiply 0.1818 by the closing price of the current day. Then we sum this together, as you can see the sum sign there, by the weight of the remaining MA. Now, if we, so 100 minus 18% is 81. Look, 81.82. If my maths is not incorrect. So we 81.82 multiplied by the previous EMA. Okay, and that will give you that will provide you with your EMA value. But look, guys, you really don't have to go over all of this. It's yeah, as I said, it is calculated for you. But as you can see, once you get used to it, it is a pretty simple calculation, but it's pretty much useless if you're using it as it's calculated for you. Right. So look, one way of, now we're back on the SMA, okay, just to be clear, the black line. One way of using the moving average, of course, is to determine trends. So look, a price cross of an EMA is a, let me just highlight this. So a price cross, so price crossing below the EMA, or the SMA, sorry, is a bearish signal. We do get some false signals here, guys, so be very careful with this. Price crossing above the SMA is also a bullish signal, and below, of course. But look at this signal. We crossed above the SMA, and look, if you'd have rode this price action to the top, which you'll never do, by the way, you'll very rarely, unless you're very, very lucky, it's very unlikely you're going to hit the top there. So it's best to always trail your positions as best as you can to get out with as much profit as you possibly can. So another false signal here, but look, we break below it here. So this is basically a trend following system. Now, with a trend following system, you have to accept that there will be a number of consecutive small losses before you hit the big one. The big one meaning this one here is where price continues to trend lower, right? And the big one here where price continues to trend higher, and the big one there, price continues to trend lower. So right, please come back to the crossing above or crossing below. I'm on that now, Adam. Are you talking about this? So all it is price is now, so in this instance here, price is, yeah, okay. Price is now below the average price of the past 200 days. So that's a very bearish signal, right? So that's all it is. There's nothing more. There's no magic to it, really. Price is now below the average price of the past 200 days. So it's quite a bearish signal. Okay. As I said, you will get whipsaws, you will get false signals. And the idea is to look for those big ones and ride those trends as much as you can. That's the idea. That's a trend following system. As I said, you will get a number of losses, consecutive losses, but if you can hold out until you get the big one, and then you can ride that wave as much as you possibly can, that would easily offset the losses you experienced when you experience those consecutive losses. Now, another one is, of course, the direction of the moving average. Now, instead of waiting for the price cross, you can also just look at the direction. Look, the direction is lower here. This could be this is a bearish signal, but lower. Okay, lower, 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 and then we turn higher. So we start turning higher here, right? This is a bullish signal. You can use that as well as alongside the price cross, and then look, price the moving average begins to level off, top out, right? And now it's lower. This is a bearish signal. This is a this informs us that we have a bearish indication. Okay. Okay, so yes, this was just really highlighting that. Look, you can also use the SMAs as they often act as support or resistance. So in this case here, we have resistance, resistance at this point as well, support at this point. Look, you'd have to have pretty deep pockets to withstand this whipsaw though. But look, the SMAs do often. They can offer support and resistance. Okay, and this is the reason for this is price. Mean reversion, right? This is all it comes down to, is a financial theory which suggests that after an extreme price move, so think of price coming down here, the asset prices tend to return back to their normal or average levels. Now, as you can see, prices come down. It really did extend below the mean price, and look, we eventually reverted back to the mean. Okay, these are really good signals. These can be pretty good signals when you're with the trend, right? So just trying to find an example. If we can, so here, for example, this could be a mean reversion. Not really though, because we've broken that high. I'm just trying to think of ideas. Yeah, so look, the main thing is that really to take away from this is the SMA, the MAs can offer support and resistance when tested. So look, and finally, the SMA, as really mentioned already, the MA crossover is a popular trend signal. Excuse me. So what a moving average crossover shows us is that the shorter term average price is now above or below the longer term average price. And this could be a sign of early strength or weakness, depending on the direction. Now, as you can see here, this is the shorter term moving average, right? As you can see, it's hugging the price action more closely than the 200. This is the 200-day SMA. This is the 50-day SMA. Now, yes, just to be clear, this is the 50. The black is the 50-day SMA, and the 200-day SMA is in blue. So as you can see, the shorter term moving average crossed below the 200-day SMA, and then finally crossed above it there. So if you got in at this point here, you would have rode all of this down, and then exited around this point here. So you'd have entered around here and exited around this point here. And again here, another one. Now this is a really good chart, guys. Do not be fooled, because you will often get the moving averages, they whipsaw. So this is a really great chart, and it shows you could have entered here long and then exited around this point here. Oops, and then gone short at this point here. So as you can see, moving average crossovers. And look, guys, when the 50-day SMA crosses below the 200-day SMA, this is often termed, you might have heard of it, as a death cross, when referring to the 50-day SMA and the 200-day SMA. Now, do not ask me where that come from. I have no idea. I've just read from many academics that this is what it's labeled as. The death cross for a bearish crossover, and a golden cross for a bullish crossover. Okay. So look, momentum, relative strength index. So deciphering momentum, the speed of price change is crucial for a number of trading methodologies. Right, so the relative strength index, or for short, the RSI, was designed by a chap who goes by the name of J. Wells Wilder. Right, Wilder basically reasoned that if gains were significantly greater than losses over a period, then the stock was overbought. and if losses were significantly significantly exceeded gains, then it was oversold. Obviously, do not confuse this with relative strength, which is a different animal entirely. Relative strength index, and then we have relative strength. So for anyone interested in relative strength, all this is a ratio between, usually a ratio between, say, the price of a stock and the benchmark, so the S&P 500 if you're looking at US-based stocks. So do not confuse these two. It's also important to note that the default period for the RSI is generally 14, but look, traders do adjust this to suit their trading style. Okay, they do adjust this. So if you increase the periods, obviously the sensitivity will decrease. But if you decrease the periods, so if you go for an 8-period RSI, then be prepared for some very volatile swings on your indicator. Now, think about momentum as the speed of price change. For example, if we have a handful of traders buying into a market, what happens is, and if price rises, what happens is you'll often get additional momentum coming into the market on the back of that momentum. So momentum will continue to rally. Consider momentum-based trading strategies. Breakout trading strategies will come into play. And before you know it, we have a strong wave of bullish activity. It's not always the case, of course, but this can be seen. So the question most traders often ask is how long will this upward movement remain in place? Are buyers going to run out of fuel or overheat, or are sellers going to throw in the towel, if you will? Price cannot continuously move in one direction, right? So another way to think about this, of course, is markets are often overreacting to news, to good and bad news. And this is where the RSI can really become a handy tool to have in your arsenal to help decipher this movement. So I won't go into too much detail here, but I will hopefully provide enough interest, enough to interest you on a beginner level. So just bear with me. So at its core, the RSI is a momentum oscillator, which, according to Wilder, measures the velocity of directional price movement, shown by a way of a value that oscillates between 0 and 100. You cannot see 0 and 100 on this chart, but this is where it's bounded. This is what it's bounded by. So the basic framework of this indicator is consists of an x-axis, as you can see there, and that represents time scale. Sorry, a y-axis, excuse me, a y-axis, and that represents the scale of the indicator. And you know, it represents the magnitude or distance the indicator has moved. And then we have the look, the x-axis will also just have the price, be the normal price data. What you'll see normally on the chart, so you have the price date and time and things like that. So as you can see here, we've also marked the overbought and oversold thresholds. Overbought, oversold, this is 30, this is 70. It will normally have the number there. Okay, so this is something we'll touch on very shortly. And we also have the 50 center line. This will also normally have the number there. Now, the 50 center line is relatively important. And look, we'll go over that very, very shortly. Now, for those, right, so for those interested in the formula for the RSI, look, it's up to you. It's totally up to you if you really want to get into this. I would probably not recommend it, but it is a good idea to actually understand the dynamics, because it makes you clearer with the indicator itself. But I wouldn't advise going too deep into this. As long as you understand that it's an indicator that's based on the average gains and losses, that should be enough. But so look, here's the, as you can see, here's the formula. Just to be clear that this was taken from stockcharts.com, this table here, just to be clear. And yeah, so look, here's the formula. RSI equals 100 minus 100 divided by 1 plus the RS. So the RS is the relative strength. Now, to measure average gain and measure average loss, what we do is we take the previous average gain, multiply by 13, and plus the current gain and current loss there, and then divide by 14. So we're going to now measure the RSI for the 20th of January, which, as you can see, is 54.71. So it's just above that 50 center line. Now, so the average gain, and the average gain and average loss for the 19th of January, this is the day before, is 0.23 and 0.14. So how to find the average gain for the 20th of January? Right, so what we do is we, following this formula here, previous average, let me just get my pen out, 1 second. So we focus on this previous average gain at this point here, and we can see the previous average gain on the 19th was 0.23. So 0.23 multiplied by 13 equals 2.99. Right, so 2.99 plus the current gain, but there is no current gain, right? So the current gain, so the current gain is empty. Current gain for the 20th of January is empty. So we put a 0 there. So it remains at 2.99. And then, as you can see here, we 2.99 divided by 14 at this point here. And that gives us this rather long value here. All right, sorry, I shouldn't have drew through that there. Bear with me. Okay, so this gives us this rather long value here. This is your average gain. This is the average gain which we'll need for the calculation. So this is the average gain at this point here. So to find the average loss, what we do is we 0.14. So 0.14 is the previous average loss at this point here. Multiplied by 13, that will give us 1.82. Now 1.82 plus 0.67. Now why are we plusing 0.67? Now look at this. This point here is the loss, right? So current loss. So we've already multiplied by 13. Then we get that number 1.82. Then we plus the current loss, which is 0.67. Then we simply, and that will give us 2.49, and then 2.49 divided by 14 at this point here will give us the average loss. Okay, I'm not even going to try and repeat that number, but there's the average loss. So to find the RS, the relative strength, we then divide 0.21, as you can see here, by 0.18, rounded there, guys, and that equals 1.20. Okay, we plus 1, as you can see here, we plus 1 for the RS, and that will give us 2.20. Right, so, and then we follow this, then we compute 100 divided by the relative strength, right? So 100 divided by the relative strength, which is there, equals 45.44. And what happens? We minus 100 from 45.44 to give us around 54.56. I know it's not the same as this, but I think that's to do with the decimal places. You can get an exact number through Excel if you're interested, guys. But it's pretty close, right? It's very, very close. In fact, this is 54.6 rounded, and this is 54.7. So it's very, very close. Okay. And on the indicator, you would probably never know the difference, to be quite fair. So let me just clear all. Look, I can feel a lot of you actually scratching your heads with this calculation. I understand, because I was one of them. It's quite a complex, calculation, and really, guys, you really don't need to remember it all. Just understand that we are dealing with the average gains and average losses, all right, over 14 periods or over the periods that you've set. Okay, right, let's get into the indicator. So the RSI centerline cross. Now, the most common signal is the bullish or bearish centerline cross. So a rising centerline cross means the RSI value is above the center line. So it moves above, okay. It moves above the center line, as you can see, above there. And, you know, what this does is it shows traders the average gains are actually exceeding average losses. In other words, in this case, we have a positive momentum. Now, a falling center line cross. So here we go here, price falling below the 50 center line. It's a bearish, it's often interpreted as a bearish signal. And this, of course, informs traders that the average loss is exceeding the average gain and momentum is to the downside. Now, this is sometimes used in trend following systems as well. Now, this is something that you may not have heard of, the Rsi Failure Swings. Now, I find these very interesting. So this is another means of trend identification, if you will, albeit not as widely known. So look, I've purposely widened the indicator here to show you, to get a closer visual. So according to Wilder, the guy that developed the indicator, failure swings are very strong indications of a market reversal. So failure swings are actually independent of price action. We don't, so we focus solely on the RSI here, and ignore the concept of divergences and things like that. So first up, we have a bullish failure swing. So to identify a bullish failure swing, we first need to see the indicator dip its toe into the 30, into the overbought threshold. And then we come up, we form a high, and then we fail to move lower. Whoops, where's the indicator? Fail to move lower. But we do not want to pierce, we do not want to probe the overbought threshold, okay? So we have 2 points here. And then once we break above this trigger line here, that's a bullish signal. And look, guys, it's the same for the bearish failure swings at this point. It's not much to it, really. It's just ensure that the swing does not enter the overbought threshold, as it doesn't here for the oversold threshold. Yeah, that's really it for the failure swings. It's not really much. Let me just check 1 second. As you can see here, this would have been a very nice entry into the market. Not so good, not too bad at this point, but not as great as obviously this one. Okay, so RSI overbought and oversold signals. So as you remember, I was talking about overbought at this point and oversold at this point. Look, the RSI overbought and oversold signals. This is your overbought, the above the 70 mark. So look, 60, 70, 80. So above here is overbought. Below 30, there will be a 30 sign there normally. Below 30 is oversold. So look, think of overbought as overvalued, oversold as undervalued, okay? Nothing really fancy. But what that means is when price enters this area, sorry, the indicator enters the area, there's a higher probability, a reasonably high probability that price will eventually rebound to the upside. Just be careful though, guys, when you're in a trending environment, a strong trending environment, think of the dollar yen. That's a really good example. That was price, the indicator can remain. So if you're trending higher, strongly trending higher, price can remain within the overbought area and cause a number of false signals. So do not take these blindly, guys. So do not take you might be looking at this. Wow, I'm going to enter short on this. I'll enter long at this point, long at this point, and long at this point here. They're pretty good signals, but just be very careful. That's all I'm saying. So how can we combat this? How can we potentially avoid being whipsawed out of a trade? You can wait for the value to cross back above the 30 threshold in the case of an oversold signal, and below the 70 threshold in the case of an overbought signal. Right, so divergences. Let me just remove this. Bear with me. Divergences. Now, these are interesting. I'm not going to go into too much detail here because this is really about technical indicators. But look, these type of divergences can also be found on the MACD, the volume indicators, right? So a number of indicators divergences work on. So for instance, if price is rallying, but volume is sinking lower, that's not a good sign, guys. That's a divergence. That's a bearish divergence where activity could be, you know, the momentum to the upside is likely to eventually fold over. So they're pretty good signals. But personally, I like to look at them within overbought and oversold signals, overbought and oversold areas. So let's just focus on the strong and the hidden divergence. So so look, regular divergences offer reversals, right? So these are the regular divergences. Let's just focus on the strong and the hidden. Forget the moderate and the weak for now. Strong and hidden. And this is regular, strong, bullish divergence and bearish divergence. This is hidden, bullish divergence and bearish divergence. So what happens is with the regular bullish and bearish divergence, this is price. Price forms a lower low. What happens is the indicator, so the RSI, forms a higher low. What this is telling you is that the momentum seen in this leg was stronger than the momentum seen in this leg. So downside momentum was stronger here than it was here. So what this has done is seen average gains starting to creep higher, right? Hence the term divergence. So this is a potential signal that downside momentum is potentially softening, and we could be a good opportunity to consider bullish bullish setups. Bearish divergence is very similar. It's the same, but just the mirror opposite. So bearish divergence, we have a higher high at this point. So price is traveling higher, higher high, higher low, higher high. Okay, at this point, but what happens here is upside momentum is strong at this point and weaker at this point. And what this does is this causes the bearish divergence. So what this is telling you is the average losses are beginning to not exceed, are beginning to strengthen against average gains. So it's not exceeding the average gains at this point, but it is beginning. Average losses are beginning to show strength. Hence the term divergence. Now look, strong regular bullish and bearish divergence at this point here are good for reversals. Okay, this is a reversal indicator, so you can look at these for trend reversals, dip buying scenarios, sell on rally scenarios within trends. Fantastic. But the hidden divergence, now this is pretty interesting. So what happens is it actually swaps over. So the price here, as you can see, forms a higher low, but the indicator forms a lower low. So what this is telling you is the price is actually showing more strength despite the indicator showing a downside momentum to the downside, okay? And the same goes for the bearish divergence. And these are usually found within as continuation setups within the trend. So for the regular bullish and bearish divergence, I tend to look for these within overbought and oversold areas. Let me just show you. So I tend to look for the bullish and bearish, bearish divergence within the overbought areas, and the bullish divergence within the oversold areas. Okay. Whoa, that's the end of that. Okay. So yes, guys, any questions? I do not see any in the chat box. Any questions, please do fire away. I know I've thrown a lot of you at this presentation, but I hope it's benefited you. Look, okay, as always, look, if you want to get in contact with the research team here at FP, please send us an email at marketsanalyst@fpmarkets.com. Again, if there are any specific topics you wish the team here to talk about, look, send over an email and we'll be happy to create something for you. For upcoming webinars, guys, we have a number. In June, we've expanded, so we have a webinar every week now. So on the 14th of June, we have a webinar on the economic calendar. And then we have on the 21st, as you can see on the chat box, position sizing on the 21st, and the importance of a trading plan on the 28th. Do also make sure to register for the FP Markets Telegram channel to get instant updates. I'm regularly active on there. So yeah, look, guys, the link's in the chat box. Please subscribe. So look, there was a question from Mustafa. Look, about market depth. I'm not sure why Oh, I'm sorry, I cannot find the question. I'm sorry, guys. About market depth. I'm not sure why you would be asking. Oh, there's quite a few questions here. So I am new and wanted to find out what is a balance, equity, free margin, and margin level. So your balance, is your account, is how much you have in your account. So if you've put 10,000 US dollars in there, that's what your balance will show. Your equity will show the same unless you have a trade on. If you have a trade on, your equity will move in relation to your profit and loss. Your free margin is your equity minus your used margin. And your margin level, which I assume you're talking about your margin percentage, is your equity divided by your used margin. What is market depth and what does it really mean? The buy and sell number shows are correct. So what do you mean? I'm not sure what you mean. Market depth. Are you talking about the ladder, the bids and offers on MT5 maybe? I've never used the market depth indicator, to be honest, so I can't really comment too much on that. I don't use that for my trading at all. I know a few traders that do, but I don't believe they use that for the retail spot FX arena, guys. So sorry, Mustafa. And margin. So there was another question, and margin. So margin, I assume you're talking about your initial margin. That's how much the broker will require you to deposit. Not deposit, it's more of a collateral. You need to put this called initial margin or deposit margin. You'll need to put that up before you make a trade. And that's where leverage really comes into play, guys. Okay, have a webinar on how to interpret a watch list. Look, for me, David, a watch list really is pretty simple. A watch list is really what you're watching, right? So a watch, maybe I'm misunderstanding what you mean by a watch list, because my personal watch list is pretty simple. So I'm not really sure what you're referring to. How do we put? Frederick, I'm sorry. How do we put a stop loss on a trade? That's very that's a very different question compared to what. Look, how do you put a stop loss? You go to your order window in MT4, which I believe is F9 or F8, and you should be able to put your stop loss in. I don't have my MT4 platform open right now, but what you look, go just please do a Google search, because this is very, very important. You should know how to. Please do not trade if you do not know how to put the stop loss on. All right, so just type into Google how to put a stop loss on the platform you're trading, and you should find some information. But for MT4 or MT5, it's pretty simple. The order window, you have your entry metrics available, and then you have a section for your stop loss and your take profit, whether you want to trade on a limit order or a market order and things like that. Expiry, when you want to the order to expire, if you're using a pending order. These are things you must know before you actually enter the market live. Okay, guys, do not trade live if you're unaware of what they how to place a stop loss, because it's there to protect you. Hence the term protective stop loss. Thank you, Bertha. That's very kind of you. Thank you very much. Good to see you again, by the way. Okay, guys. So look, if there's no other questions, have a great evening. Or a great day from wherever you are in the world, and I'll catch you all again very, very soon. Thank you so much, guys.